Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Caleb Frankert, and I'm joined by my good friend and fellow money muddler, Jason Burnell.
Caleb, can a podcast about finance be entertaining?
Not without alcohol.
All right, let's mix it up.
Woohoo!
Kind of brew it up today, right?
Yes, brew it up. That's right.
Yeah. No beer.
No,
Coffee.
there's an idea, though.
Ooh, it is.
There's a lot of stuff going on in this one today.
Yeah.
We're going to get into the weeds with this drink, Jason.
Oh, good. I'm glad there's
For
whiskey.
a few reasons, we're going to get in the weeds. There's controversy surrounding this one.
Ooh.
I mean, in that there's a lot of different recipes.
Cue the dismal music or whatever. Dun, dun,
Yeah,
dun.
it's not. None of this is consequential.
No.
Controversy. But
No,
anyway,
nothing like
now
that.
when we get to the finance topic, that's a different story.
That's true.
We're gonna get into the weeds big time, and there are consequences.
Yes.
And you know what? I'm trying to not set this up too much right now, but what I've run into is clients who were never really given any guidance or advice, and they did something that they thought, I should do this. This is good, right?
Yep.
Find out, what did we just do?
Yeah, it's the whoopsie.
Yeah.
And it usually comes up about this time of year for some reason.
If not,
Yeah.
at what other time? Tax time.
But
which-
I mean, and
not a good time for it to come up.
I realize that this is late in the year, but a lot of folks are filing extensions.
More than
filed
ever.
extensions are now filing their taxes for the year, so they may not have gotten their real numbers until now. So
Yeah.
it's
More now than ever, I think.
Right.
Actually, we might have had a record number of not late filers, but extension filers.
sure,
Yeah.
absolutely.
Well, Jason, are you ready to get into the weeds?
I am. I love it.
Are you ready to
We're
muddle
nerds.
it up?
I'm excited.
We are about to muddy the waters.
Oh,
okay,
gosh.
but before
put your thinking caps on, people.
before we do, let's muddy the waters with something, like I said, inconsequential, which is a cocktail. If you could call it a cocktail, I don't know. So we're drinking the
yeah.
Nutty Irishman today, and if you're
Yes.
listening, Grandma's probably got a recipe for this.
Yeah, this is an old one.
It is.
Mm-hmm.
Lots of people have a variation of the Nutty Irishman. A lot of people claim that this is the original. I tried as hard as I could to go with what seems to be the original based on my research, and I'm not going to share that research because we're not going that far into the weeds.
No.
But what the original Nutty Irishman was, and I think what it's transformed into now. Well, let's do this. Let's get in the weeds.
Sure.
You can do this a lot of different ways. You can do this iced,
Yes.
right? You can do this hot.
Mm-hmm.
Let's get into the ingredients. We just need to get into this.
Yes. Well, yeah, and I'm
All right.
again. I'm always I'm like waiting to take a drink of this after we make it. It's like
The ice is melting.
it is.
So we used ice. All right. So the original Nutty Irishman, by
Mhm.
accounts that based on my reading, is 2 ingredients.
Yes.
3 if you count ice.
Okay.
Okay. So we're going to do one of these, and then
Yes.
we're going to do a more modern variation. But what we're drinking here is quite simply 1 ounce of Kahlua and 1 ounce of, we used Frangelico, which is a hazelnut liqueur.
It looks like Mrs. Butterworth.
It absolutely does. You've
Yeah.
seen this one at the liquor store, I'm sure, or at Meijer, Kroger, whatever.
Yeah, because this is not like a high alcohol content.
You're right. It looks like a syrup
It's a
bottle.
liqueur.
It's a 20%. I believe that's a monk. I don't know, with a robe and a belt.
Okay, now I see it.
You
I
see
see
it?
it. Oh, it is. So it is like true.
Yeah.
That's what the
Yeah,
rope's about. There's a rope on the bottle.
Wait a second. Here it is. Frangelico liqueur. According to legend, Friar Angelico. Well, there you go. Angelico lived 3 centuries ago in rolling hills of Piedmont in the shadow of the Italian Alps. This sounds like what was the other one that we tried? The
Benedictine.
Benedictine. Yes, yes. I think it's in that same kind
It's
of.
gotta
It's a
be.
cordial. It's a
Yeah.
liqueur, which historically go good with coffee, right?
Yeah, absolutely. Well, so does Kahlua.
Spoiler
I mean,
alert.
I think everyone has a bottle of Kahlua in their desk drawer, don't they?
Sure. Let's try the original Nutty Irishman.
The original.
Ready,
No
set?
whiskey in this one. Yep, ready, set, go. That's really sweet.
Whoa. My
Dude,
goodness.
I did not expect that
Mm-mm,
because
me
we
neither.
smelled
Yeah.
that's good.
The Frangelico smelled, well, okay.
That's a dessert.
Remember earlier we were talking about, and I said, save it for the podcast.
Yeah.
I thought that it smelled like those Ferrero Rocher,
Yeah.
however you say Rocher, those hazelnut chocolate
Chocolates?
ball
Yeah.
things. Yeah.
I said it actually to me smelled like chocolate. That is like,
Hey, that's good. I like that.
it's dessert.
If that's the original
Oh,
Nutty
man.
Irishman, I could see why this holds up.
Oh.
You're right. That's a dessert. That's an after dinner.
Not what I expected.
No. I expected coffee.
Oh, I'm excited.
And whiskey.
Now. All right, let's do the next one.
All right, so a more modern variation. We used strong brewed coffee. Strong, okay?
Truck stop coffee. Check.
Yeah, pretty much. So 6 ounces of it, to be exact. 6 ounces of strong coffee, okay? 1 ounce of Kahlua, 1 ounce of Frangelico, Frangelico.
Yeah.
And 1 ounce of Irish whiskey, right? Because it's a nutty Irishman.
Right. Tried and true. We just went to Jameson.
We went with Jameson.
Yeah, nothing fancy here, but
We have ours on ice.
I'm really excited about this.
Cheers. Let's try it.
High expectations. Here we go.
Oh yeah.
Oh
hey,
man.
you know what? With the ice, that tastes like sweet tea.
Oh my gosh, that's.
I'm
good.
sorry, unsweetened iced tea. It's a little sweeter than unsweetened iced tea. Do it again. Going again.
That would get you in so much trouble.
I know.
Oh,
I know how I'm making my coffee from now on.
That is awesome. I'm sorry, I've not had a reaction to a drink. Last week's drinks was awesome too. This one is also.
This is really good.
Really good.
Both of these are good. In fact, I want to drink this and then I want the original for dessert.
Basically. I know. So we had it's pumpkin spice season.
Yes.
Okay.
Well, for some of us.
Yeah, for me at least. Everything becomes pumpkin spice September 1. And so I was like, maybe a splash of cream in this would be smart. I'm going to do
a lot of the recipes do use cream. We didn't in this one, but
I'm going to put a splash in this. I don't think it'll ruin it.
Just to make it look pretty.
Oh.
It does look fun.
Okay, I'm going to try that with cream. Oh my gosh, dude. This is like Starbucks on steroids.
Ooh.
Isn't it?
I like it a lot. I'm
Dang.
really getting like an unsweetened iced tea, just a little sweetened.
Well, that's that brewed, coffee kind of hot brew stuff. And then maybe a little more whiskey for me.
No, you know what it tastes like? Okay, you know the sweet tea that you get in the jugs down south?
Yeah,
right?
Oh yeah, yeah.
The Milos. It's almost like a half and half of unsweetened iced tea, and then that's what I'm getting. There is a sweet tea flavor in there. It's just not overpowering. This is good. I like this. This is good. I don't know. I'm not going to do the pumpkin spice, but hey,
I am.
You like it.
Well, now I got like cinnamon in there, which is like
Does it
I'm
go
happy.
well?
I'm a happy camper. That's not the drink. This is
dang. That's good. Try it at home, folks.
not hard.
No, not hard at all. Neither of these are hard. And this is all stuff that you can get readily available. This isn't one of those things where, maybe you can find this in your state at your liquor store. This is everywhere. All of these ingredients are readily available. You can get everything at the grocery store, minus the Jamesons. I mean, you can, but it's going to be the low-proof stuff.
Don't do that.
Don't skimp.
Yeah, because actually the whiskey's kind of hidden in there a little bit.
It is. It is quite hidden, actually.
It's there, though.
All right.
It's there, I promise.
So we got into the weeds. I referenced controversy. The only controversy really was that a lot of people claim to have the original recipe, So we tried the one that I thought sounded like the original. I'm not an authority on this, and neither are you.
But both of them are definitely good. Yeah.
You know what else is good?
Yes.
IRAs.
Yes. Retirement.
Do you want to get into the weeds with IRAs? Let's do this.
Yes.
Let's dive all the way in. Let's muddy the waters.
Oh gosh. Which makes sense.
Yeah, because we're putting the cream in the coffee here.
Oh, I did.
Spoiler alert.
I put cream in my drink, so.
All right, so let's get into it. What we're talking about today, the title of the episode is Should You Contribute to an IRA? Now, doesn't that sound like a dumb question, Jason?
It is a dumb question.
Because I wrote it. All right, so sounds obvious. Sounds obvious, but there is some nuance here with this one, definitely. And this is going to be a heavily nuanced topic. So
yeah, but
that's why we mixed a coffee cocktail. You got to stay awake and alert and with us on this one.
That's right.
Right?
But the first part of this will apply to everyone.
Absolutely. This is insanely practical stuff.
Right. So please stick with us. It's important. I mean, IRAs are good, right?
I'm for them.
I'm for them. So, okay.
I ain't again it.
So here we go.
All right. So IRAs. Should you contribute to an IRA?
Yes.
Yes. What kind of IRA? Depends.
All of them.
Depends.
No, it depends.
All right. So let's get into it. Who can contribute to an IRA, Jason? Who can contribute to a traditional IRA? The answer is anyone.
Correct.
Where the nuance comes in, where it gets muddy, where we get into the weeds is, Well, what's deductible though?
Correct.
Can everybody make deductible?
Don't forget though,
contributions?
you gotta have earned income.
Oh, that's true. Yeah, that's
let's
an obvious, I guess. But
yeah.
we shouldn't understate that.
You need to be working.
Earned income.
Okay. And if your spouse is working, they get you through the gate.
Yeah.
Okay.
And earned income, we'll say, just as a caveat, not Social Security, not a pension, not annuity income, wages. Bingo. Okay, so if you got wages, you can contribute to a traditional IRA. The question is, where we get into the nuance and the weeds is it deductible?
Correct.
All right. And
so is it going to provide a tax benefit to you when you file your taxes?
Right. Can you claim less income because you put money into a tax-deferred vehicle? We like tax deferral, right?
Most of the time.
I mean, there are better options, I think.
Sometimes.
There's good, better, and best, right? But they're all good options. But yeah, so deductibility is a big one, and especially when we're talking about tax time, which is when we generally realize, maybe we did a good thing, but it didn't turn out to be a good thing, right? So let's talk about who can contribute just a little bit more. So like you said, got to have earned income. And as far as deductibility goes, so in 2022, the contribution limits are $6,000. This goes for a traditional or a Roth IRA for folks who are under the age of 50. Over the age of 50, you get the catch-up, $7,000, okay? That's what you can contribute to a traditional IRA. So anyone with $7,000 or more of earned income can contribute. But let's talk about whether we should or whether it's deductible, okay? So getting into income limits, if you're a single individual at $68,000, okay, if you have a retirement plan at work as well, right?
Yes.
At $68,000, you're going to start to phase out your deduction.
So that means you can contribute.
You can contribute,
but you're not going to get a full tax benefit.
You're not going to get the full deduction, which if you're in this partial range, which runs from $68,000 to $78,000, this really, really muddies the water.
Not confusing at all.
No. In fact, well, I'm going to say it here because this is
you
where
heard it here, folks.
You just poured a little bit of cream into that coffee, didn't you? Jason, do me a favor and get the cream out of that coffee.
I can't.
Okay.
Crap.
Yeah. All right. So we'll get into that.
Yes.
Pause. But anyway, if you're single, you're covered by a plan at work. If you're above $78,000, sorry, no go. That's a non-deductible IRA. Okay.
Correct.
If you're married, the phase out begins at $109,000 up to $129,000. $129,000 is the phase out. Okay. So that's if you are covered by a plan at work. So a 401k,
right,
403b, something like that. All right.
So you have a job. What if you're not contributing to your 401k?
Doesn't matter.
Doesn't matter.
Doesn't matter. Let's say you have a 401k that doesn't match and you've decided, I don't want to do this.
Right.
I'll go do my own IRA because I have more options. Might not be a good move, right? So should you contribute to an IRA? In that case, you should contribute to your 401k because, well, there's other places we can contribute to. But
in these phase outs, is this my gross income or my modified adjusted gross?
This is your modified adjusted gross income.
The Magi.
Yeah, the gift of the Magi.
Mm-hmm.
All right. So let's talk about if you're not covered by a retirement plan at work. Okay. If you are not and you're a single person, making any amount of money, if you're not covered by a retirement plan, you can make a deductible contribution.
Right.
But what if your spouse is covered and you're not? Well, we're going to muddy the water again. Thanks, IRS tax code. Let's make things complicated. If you're married, filing jointly, and your spouse is covered by a plan at work, $204,000 of modified adjusted gross income or less, you can, and you get the full deduction. But you start to phase out at 204 up to 214.
Right.
So at 214, no, not deductible. All right. So before moving on to Roths, let's talk about why anybody, Jason, would want to make a non-deductible IRA contribution. Why the heck would you do that, right? Because let's talk about how an IRA works with tax deferral, right? You put the money in, it grows tax-free until you take it out in retirement, right? And then you pull out income and you pay taxes.
Yep.
Tax deferred, right? So with a non-deductible contribution, that money goes in already taxed, right?
Yep.
And then it grows tax deferred.
Correct.
And when you pull it out in retirement, what happens?
Taxable.
Except for your original contributions, right? But now we get to calculate
30 years that and that's assuming that you only ever did non-deductible contributions, this is what we're talking about, getting the cream out of the coffee.
Yeah, so that's what we mean by cream in the coffee. You've got taxable mixed in with you've got tax deferred mixed in with taxed already. Right. Okay. So
And guess who's responsible for keeping those records? Yep.
Not me.
Nope.
Not even your tax guy.
Nope.
You.
Yep. Exactly.
Jason, I'm talking to you. No.
I know you are.
Okay, so why would you do it?
Right. Why would you do this? So, one, you would do a non-deductible traditional IRA contribution because you can't contribute to a Roth.
Correct.
Okay. I'm going to say it again. You would do it because you have been phased out of the Roth IRA just like the traditional and hit it.
So let me, So let's talk about that, right? For a single person.
So just like the traditional IRA.
Eligibility.
There's eligibility.
Yeah. You're single person and the contribution numbers are the same, 6,000 or 7,000, depending on your age. But if you're a single person and you make over $144,000, you are not eligible to contribute to a Roth IRA.
Cannot put after-tax money into a Roth IRA.
If you're married filing joint, this phase out starts at 204 up to 214. I should go back and say the phase out for a single person is 129 to 144, but after 144 you're done. You cannot.
So, moral of the story is if you're in this income range, you better be getting some advice because it gets real murky.
Yeah, okay. and then there are deadlines to get things done. If you made an
Yep.
Yeah.
Yep. And so here's what's surprising me.
All that being said, though, Jason, I'm sorry to interrupt your train of thought, but you can't contribute to a Roth IRA, so you think, well, I'll do the next best thing.
Mm-hmm.
I can't contribute to a Roth. I made, that's a higher limit for income.
Which is so weird.
So I can't make a deductible contribution. So why would I do a non-deductible IRA contribution?
Because the IRS, in their wisdom, has made something a loophole. I don't know how else to put it, because that is exactly what it is.
It's for the rich.
It's a loophole. It is a backdoor Roth IRA contribution.
Yes.
Okay. That means we put a non-deductible contribution into a traditional IRA.
So remember, non-deductible meaning we already paid taxes on that in Uncle Sam's eyes.
And then we're going to do some paperwork, and Swiper's going to come swipe that money right out of that traditional IRA, and we're going to put it into the Roth.
We're doing a Roth conversion, right?
Correct.
On non-deductible assets. So
correct.
Net effect to you is, and by the way, I guess we should have set this up, disclaimer, that a Roth is after-tax money.
That's right.
That grows tax-free.
Correct.
That will never be taxed again.
And since this contribution you just made to a traditional IRA was already taxed,
mm-hmm.
and it wasn't in there long enough to grow,
mm-hmm.
okay? And it probably wasn't even invested.
Right.
Okay? We're going to convert that money right over to the Roth IRA.
Which a conversion means settle up on the taxes. Oh, I guess I already did.
I already did that.
Yeah.
So, if you're a thinker like I am, you would say, why would the IRS do this? Why would they have any income limit on a Roth IRA? That's a great question.
Because they like audits.
I feel like this is a bit of a raise your hand if you have a skilled tax or financial advisor working for you.
Yeah. You know what? I think it's more egregious. I don't think that it's that the IRS is just inept. I think that this is left open for people who make a lot of money.
Yeah.
I mean, the tax code really is, this is an aside, I'm sorry, but the tax code is really, we talk about how it's
controversy. Come on.
Well, we talk about how the tax code, we always say, oh yeah, the wealthy pay a lot in taxes, but the ultra wealthy get away with not paying a lot in taxes.
Right.
It's designed for ultra wealthy people. So these loopholes are scattered throughout the tax code. Let's be honest.
And I mean, the sad part about this is these income limits, for example,
mm-hmm.
They set these limits in the tax code. And what has happened to folks' wages over the last 2 years? We've had significant wage pressure. Okay. Everyone's getting raises, right? Okay.
Wait.
At least for now.
What?
We'll talk about that later.
After?
Tomorrow's Friday and I have a box. Just kidding.
I always have my box ready to go on Friday.
But my point is that this is sneaking up and surprising people now,
mm-hmm.
especially husband, wife. They combine their incomes and they go, uh-oh, we're phasing out.
Yeah.
Okay.
Or we went right around this.
Right. And again, on either traditional or Roth contributions, it could be both. So I think that don't assume that this is biting the ultra rich, because it's not.
No.
You got two pretty successful folks. they're probably in this
We're
situation.
talking solidly middle upper class folks here.
Right, exactly. I mean, a couple $100,000 a year in income is a lot. Don't get me wrong. But the traditional IRA limits are a lot lower than that.
Upper middle class.
Yeah, upper middle class. They're doing well, but they're probably they wouldn't necessarily even know this was something that could happen to them.
Why would they, right?
Right.
Let's start to practically flesh this out now, Jason. So let's say that you were in that situation where you accidentally made more money or you do your own taxes, let's say, and you go, well, okay, contributing to my 401k. I heard about making traditional IRA contributions at the end of the year. So let's say someone makes $80,000 a year, single individual, and they have a little bit of extra money. They're making a decent wage. They go, well, I've heard about making an IRA contribution and being able to deduct on my taxes. Great, I'll do that. So I walk into my local bank, I make the $6,000 contribution. I walk out, I say, okay, great. Tax time comes around, and you're doing your taxes. TurboTax tells you, this is a true story, by the way. TurboTax goes, sorry, no, that is non-deductible. You contributed to a 401k, which means you have one of these available, right? And you made a traditional contribution, but you don't have enough deductions and things to get you down below that level where your MAGI is within that range. Now what do you have, Jason? You effectively have cream in the coffee.
That's right. If you already had a traditional IRA, I got $100,000 in my IRA, and I added $6,000 more to it, and I let it grow. Now you have to be able to separate the cream from the coffee.
Let me ask you, how did you separate the cream from that drink there? A sip at a time.
A sip at a time. That's right. And so
along with the regular coffee.
When this money starts to come out, okay, you're 59 and a half. Congratulations, you were responsible and you saved and you retired at 60. You start taking money out, you're going to have to take out non-deductible after-tax contributions to your traditional IRA as a proportionate percentage of the total.
So simple math, you have a $100,000 IRA, you made an oops years ago, and $5,000 of it was a non-deductible contribution. 5% of every withdrawal from here on out is going to be non-taxable, whereas 95% will be taxable, right? That cream is in the coffee. It's coming out proportionate.
And then do it again the following year.
Yeah.
And the following year. And the following year. It gets really, really complicated.
You know where it gets really complicated is when you make years of these contributions on accident.
That's what I mean, yeah. On accident, sure, yeah. Because then we've had some creative math that has to be done.
Yeah.
When you're like, I bought this, I sold this, I bought this, I sold this.
At some point, you have to go, look, I did my best.
Yep.
Here it is.
Lick the finger and put it in the wind kind of mentality. Like,
I think seems about right.
I think I got it pretty close. And I do think that the IRS would probably be okay with
they're very reasonable.
Well, you just have to give an explanation. Why did you do what you did?
Yeah.
And did you realize you made a mistake?
Because the tax code is so freaking complicated. That's why.
Right. And I had a CPA tell me to my face. She said that I have to explain this sometimes more to an auditor than, and so again, you don't want to go down this road if we don't have to, but it doesn't mean this is a bad thing, right?
Right.
So let's say, Caleb, you make a contribution that's non-deductible.
Yes.
And now you got cream in the coffee.
Yes. Hey, you know what? Can you hold that thought?
No. Yes.
Please.
Go.
Because something that we need to make very, very clear is the cream in the coffee. Let's think about it this way. An IRA here, an IRA there, an IRA there, right? When you put non-deductible contributions in one, you've effectively done it to all of them in the IRS's eyes. So whether you have a traditional IRA, at your local bank and at your broker dealer, wherever, and you did it at one place. Now the cream's in all of the coffee.
The IRS always views
it's one pot of coffee.
All of your IRA assets, traditional in one bucket, Roth in another. That is just how it's done. For required minimum distributions later in life.
Yep.
For this same rule, they're going to do that. So, but one thing that we just mentioned, we did talk about Roth conversions.
Yeah.
And so to me, that is like kind of a silver bullet solution to solve some of this.
Well, we have to be real careful about how we do it, don't we?
That's right. And so the reality is don't think maybe you did this. and you assume that the only option is to maybe get money out.
Well, the first thing you would think is, I made a non-deductible contribution. Right. Okay. So let's do that backdoor Roth thing that Jason was talking about. Yep. Now, hang on,
folks.
Hang on. Do you have other IRAs? Because if you do, and here's a practical situation, right?
This has happened.
Client A put $6,000 into traditional IRA thinking that it would be deductible. Tax time rolls around, not deductible, right?
Ruh-roh.
We sit down and we talk and we go, well, we could look at a backdoor Roth. The money has never earned anything.
Right.
That seems like a no-brainer. We sit down, we see other IRA assets, and we go, hold on.
Right.
So if I take that $6,000 and do a contribution, that's not $6,000 that's already been taxed. I have to take $6,000 and say, what percentage of my overall IRA assets does this represent?
Correct.
And we're taking the cream out with the coffee. So in the case with the gentleman that I was working with on this, we'd say, let's make sure we do our due diligence and we don't screw this up. After digging, we go, hey, you know what? About $100 of it was going to be non-taxable and the rest was going to be taxable. We effectively didn't change our situation.
That's right.
We converted $100, not $6,000.
Exactly.
And we still have cream in the coffee. It will always be there. There is one way to get it out, though.
Ooh.
If you have a retirement plan at work,
that's right,
which might have put you in this position in the first place.
Thanks,
right?
guys.
You can take all of your IRA assets, dump them into your work 401k.
Correct.
Aside from that non-deductible contribution that you made, right? Now, the only IRAs that you have are non-deductible.
That's right.
Roth conversion.
Boom shakalaka.
And then you can take your money out of your 401k plan and dump it right back into your IRA if the plan allows.
If the plan allows. So make sure you understand those rules.
This is delicate stuff.
It's delicate. And so this is, I mean, I know the last few episodes are like, you need a financial advisor. You need a financial advisor on this one. Like someone needs to hold your hand through this. If you messed up, it's fine. Listen, I am probably one of the biggest advocates you'll ever meet regarding Roth conversions.
Absolutely.
I do giant amounts of them all the time.
Sometimes you scare me.
I scare you a lot. Hundreds and hundreds of thousands of dollars converted out of people's IRAs on a regular basis, including mine. You know, like I'm converting and like being crazy, paying the taxes now because I firmly believe taxes are going up. Okay. And I think the people that have saved, okay, and have been responsible to save for their own retirement, to take care of themselves, are evil and will be punished. Okay. And I think the sooner I get it.
That's sarcasm, folks.
It is sarcasm. But I tell you what, I think those folks are going to be in a situation where, you know, having as many of your assets in tax-free areas as you can get, the better. And that is why I'm willing to write those checks from my savings account, right, to pay the taxes. And all this is really saying is that, one, don't assume you can't because of the phase outs, right?
Right.
That's huge. Don't assume that you can't.
You need to talk to somebody who can figure out the intricacies and, quite frankly, the tiptoeing around some of these rules that we have to do.
Right. And don't just pull your money out, you know, of a contribution because you're like, oh crap, I screwed up.
I think any contributions and any distributions from retirement accounts need to be gone over with your financial advisor. If you don't have one, these are situations where we pay for ourselves, definitely in these situations. So I know it sounds really like we got really into deep, murky waters here. Like these are really one-off situations. Jason, no less than 3 times last week did we run into this situation.
I know. It was like, we got a break for like a half a minute and you came in the next day like, dude, I'm like, come on.
Again. And then it happened again.
At least we know how to do the math.
And then it happened again. So yeah, this is consequential stuff. It's heavy duty stuff.
It is.
That you need help with. And these are delicate matters. So
good one, Caleb. This was good.
This was
the drink was good.
I hope the topic was good. I hope people.
Well, we love
something.
this stuff. So I'm sorry, folks, but that's just the truth. We love it.
Well, thanks for having a drink with us this week, folks. It is time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance podcast, be sure to email us at podcast@bluejfg.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with the latest action by following us on Facebook. Old Fashioned Finance is brought to you by Blue Jay Financial Group. That's bluejfg.com and produced by Podastery Studios. We've been your hosts, Caleb and Jason. Cheers. Blue Jay Financial Group, LLC. Blue Jay is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction unless otherwise permitted by statute. Follow-up or individualized responses to a consumer in a particular state by Blue Jay and the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant an applicable state exemption. All verbal and written consent on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.